Welcome. A physical inventory is when management personnel go out and at least, go out and physically count the inventory. Now, why is a periodic physical counting of the inventory necessary if you maintain a perpetual subsidiary ledger for every single kind of inventory that you have? Well, the answer is you may have made some mistakes, just in terms of accurately accounting for that inventory, and those mistakes may need to be corrected. And ultimately, you only have as much inventory as you physically have on hand. So periodically, we can check it just for accuracy, but the most common reason for a discrepancy between an actual physical count and the amount that you've got recorded in your accounting records is usually because of something we refer to as pilferage or theft. Customers shoplifting or maybe even your employees taking on an unauthorized basis some of these inventory items. You will never know that through the accounting system because they don't want you to account for it when they're ripping you off. Ultimately, the only way you'll ever determine that is by going out and physically counting the inventory. If we think we have 300 cases based on a perpetual inventory accounting, and we can go and count them and discover that we only have 270 cases, well, you've either blown your accounting or what's most likely is some of that's probably been stolen. It's necessary under generally accepted accounting principles, requirements by the Securities and Exchange Commission for publicly held companies, that when you're going to provide financial statements at the end of a period, you cannot simply rely on your perpetual inventory records. And in fact, companies are required to perform a physical inventory to verify the balances. Some of you may have actually participated in some kind of a physical inventory at a business, which is usually done at the end of a year or an accounting period to make sure that we've got the accurate amounts in the books. If in fact there is a discrepancy, the books and records need to be adjusted. This would be an adjusting entry at the end of a period. In fact, if we had less inventory than we thought, we would probably have to credit inventory and debit pilferage expense, or I've been ripped off, or, my shoplifting expense, or it's some cost of doing business. You see, the fact that sometimes inventory gets misplaced or thrown away or stolen is just one of the costs of doing business. And when we reduce an asset or inventory and it reflects some cost of doing business, we refer to it as an expense. So we would need to adjust to account for any discrepancy between our physical inventory and our actual inventory perpetual records by crediting inventory and debiting some kind of an expense.